Alright, so the next tool that I will be introducing is the fair value gaps. So the fair value gap occurs when price moves rapidly, leaving a gap between consecutive candles, indicating inefficiency in price delivery that the market is likely to revisit. So market inefficiencies. Fair value gap highlight areas where price has skipped levels of balance, often acting as a magnet for price to return and to fill up the gap. So you can use this as entry or exit points. So traders use FVGs as precise zones for entering trades in alignment with the prevailing trend or taking profits during retracements. And then it is time frame sensitive. So fair value gaps on the higher time frames are more reliable or strong or stable and significant, offering stronger confluence for trade setups compared to lower time frame gaps. So one tip that I can give you right here is try to find overlapping fair value gaps. If you're seeing a daily fair value gap, go down and see the H4 fair value gap and try to find within that a H1 fair value gap. Then you just keep getting more and more precise while it's stacked on top of the larger time frame. And last point, you have to confluence with other concepts. So combine FVGs with other stuff like order blocks, dealing ranges, the 50% mark or the OTE would enhance the trade precision and increase the probability of success. So during your first few years of trading, you would just be collecting all these different entries, all these different trading strategies, and then using them for like 1 month or so and then considering them like useless. So instead of doing that, you want to collect all these tools and then implement them on different seasons of the markets because they all work, but you just have to choose the right time. And the right time actually comes a lot from experience. So if you want to enhance your trade position and increase the probability of success, it's not just the technical part. It's definitely that innate feeling, when you trade long enough in the market to know that, okay, this news tend to do this. And then this day of the week tends to do this. So combining all the different tools throughout the year will then give you the high probability success strategy. And this is also why ICT would recommend people to at least just go through 1 year of learning his concepts before trading with their live money and all that. And right now with all these funding accounts and like different kind of demos out there, you don't even have to use your money anymore. Just keep trading demo until you're so consistent, you have this data, and then put it out there. Someone will probably sponsor you, your first funded account and offer for you to manage it for them, even though you may not get like 80-20 or whatever profit split it is, but at least it's free. Like there's so many people out there looking for other people to make money for them that you don't even have to use your own money anymore. But obviously when you use your own money, it feels a bit different, and then you get to work on yourself in ways you never do when it comes to demo trading. But also for those who really can't get past that level, just keep doing demo will get you like funding. And if you can stay in that mindset without looking at the face of your investors, then you can become very successful making money for other people. So basically what I'm trying to say is that in the beginning of the years, when you are collecting all these different tools into your trading strategy, know that it might not work now, but it might work later. So whatever you're learning is never wasted. You just have to gain more perspective of the market to know when to use what. And that comes with experience, which is why you should put in the years, like before you get too crazy into putting your money and then thinking that trading doesn't work, right? We have so many examples that trading does. The only thing that you're not seeing on top of all these profits is the time that they spend outside of the markets. What are they doing to sharpen themselves? What are they doing to break through some of their old habits that are not making them money, that are costing them? And these are all reflections that you go through when you put in the time into the market, that alone time, that time when you're not looking for anyone's validations, and it's just you and you. So when we talk about that 1 year of practice in the markets, it's not just about the technical analysis, but it's mainly the psychological. And once you get the psychological part right, that is when the voice tells you, okay, this is the time to use this strategy. This is the time to use this strategy. So don't look down on the time invested. Like, because it's not paying you, it pays you in all other forms. Okay, so Confluence, finally, moving on. So now we have the dealing range. We stacked it on with like the semi-quarters, and then we have the liquidity pools, right? And then now we have even added in the fair value gap. So here you can see from the high of this candle to the low of this candle, price has only visited this entire area once. So if I was to draw out this entire area and pull them forward into time, you can see how price have precisely just tapped on the end of this entire box and then went higher. It's as though it's saying, I have some unfinished business over here and I want to get it done. So the moment it's done, it's like, okay, I can move on now. And then next, I am going to mix the fair value gap. So this is how it looks on the daily time frame on NQ again, when I overlap multiple different fair value gap. So what we see just now was this one. So now I'm just mixing multiple fair value gap, including inverted fair value gap. So the last one we saw was this box, and you can see how price turned the moment it reached into the bottom before going higher. And what we can see right here is an inverted fair value gap, where this red price only visited this area once, right? So we have the low here and then the high here, and when I draw out the box, this is an inverted fair value gap. So I'm also seeing how price reacts when it reverses higher, right? So what I like to see is also this kind of fair value gap type movement, where it moves so fast away from it that it leaves the opposite empty. And last but not least, we have this fair value gap over here, right? Inverted fair value gap, where the red price is only visited once, and then I extend it out, and even after all this mess that happens, what I'm looking for is the overlap into this kind of prices, right? So I drew it out. So now we have this area, this precision area, where 3 of the fair value gap have overlap. So what we're going to do next is to go down into the lower time frame. So one more thing is what you can see, right? All this fair value gap that I have marked out is already drawn the moment price marks out this precision swing point. So when it starts returning, all these levels are already on your charts. Okay? And then now going down into the H4 time frame. So these are the 3 overlapping fair value gaps. On H4, we can see a precision fair value gap over here, right? Which is in line with that 3 that I was talking about, right? So here we have the high of this candle and the low of the next, and then we get this nice little H4 fair value gap, where you can extend it out into the future to wait for price to return into, right? And then for the next part, you can see that this entire range, if I pull out from 100 to 0 retracement, you can see that it falls within the 61.8 to 78.6 level, right? So over here, one entry, and then price move away, gave a second opportunity before ultimately taking out the previous swing high. So that is how you use your fair value gap. So for today's episode, I want to stop here because that's already a lot to digest, but we have mainly touched on the larger time frame happenings. So this is what I look out for when I'm looking in the larger time frame. I want to make sure that all these levels are out. I want to make sure I know what time I'll be showing up in the market and where are the nearest liquidity pools or the fair value gaps. For the next episode, I will be touching on the power of 3. So we'll be going down into the smaller time frame on how mastering the power of 3 can help you anticipate market moves before they happen. And then we have OTE, optimal trade entry. So I touched on it a bit, in the last slide, but I'll go more into details for the sweet spot as OTE. And then we will talk about the swing trades versus intraday trades. So when to choose the larger time frame trade and when to choose the intraday or both. And then next we'll touch on the Q zones, Asian session, London session, New York AM and New York PM. So last but not least, we will be adding in some case studies to put it all together, get the understanding right there, get some examples on swing trades, on intraday trades, the risk to reward that you can expect from this trading strategy and from all these tools that I am currently using. So that's it for today. I hope you guys like this video. Subscribe because I will be churning out more of such detailed technical stuff with a bit of mindset stuff when you're least expecting it. So leave a comment on what you like the most about this video, and I'll see you guys in the next one. Bye!